Welcome to ET webinar powered by TransUnion Cibil. Today we will try and understand the potential of the Indian retail lending market and what does it mean for the consumers. Over the past several years, the retail lending market has grown manyfold with large number of consumers entering the credit market. In today's session, we'll talk about the trends and issues that impact the lending marketplace and how Cibil is playing an important role in the lending industry. We have with us Mr. Yogendra Singh, Vice President, Financial Services, Research and Consulting, TransUnion Cibil. Very warm welcome to you, Mr. Singh. For our attendees, I must say that Mr. Singh brings along a vast experience in the field of financial services and has worked in different capacities such as economist, strategist, and fund manager with CRISIL. He has also been associated with First Gulf, to name a few, in India as well as abroad. To begin with, Mr. Singh, please share your thoughts on the current state of the industry. Do you think we have reached a saturation point or is there still growth potential left?
Thanks a lot, Pallavi. I think, that's the whole point of this presentation. I mean, personally, we think that there is a lot of potential still left in the Indian market. And over the course of this presentation, we'll lay out the salient ways in which this potential exists in the market and the ways in which you can leverage this potential. So without much further ado, let's start off with the presentation. And over here, we'll, let's say, think about doing the potential estimation in a couple of different ways. One is you can identify the size of the market by looking at the amount or the rupee value of loans that the industry can have, or alternatively, the amount of the rupee value of the borrowing done by the Indian households. Another way of looking at that is by looking at what's the number of Indian customers who theoretically can take a retail lending. And in this presentation, we'll try to estimate the market size using both the approaches. So first, we'll start off with the household debt estimation. Now, the problem of household debt estimation itself requires a lot of different steps. I mean, we have used around 5 steps to come up with the overall potential size of the Indian household debt. So the first step is how you have to understand the linkage between per capita income and household debt. Then we'll have to do some comparison of India with a few comparable countries on a per capita income basis. The third step would be to understand how does the current household debt in ratio to the GDP is comparable to the other comparable countries. Then what we do is we narrow down on China, which is probably the closest comparable country that we have, and we'll try to understand the evolution of China and India from a per capita income perspective, from a household perspective, and utilize those experiences to forecast the likely scenarios of medium-term evolution of household debt in India. So moving on to slide number 5, over here, as you can clearly see, there is a decent level of correlation between GDP per capita, life expectancy, and household financial assets with the household debt. Now, this is a study which was done by the Bank of Italy over a period of 1995 to 2013 for somewhere around 33 odd countries. The 33 odd countries included all countries within the European Union, as well as other advanced countries like US, Canada, Australia, and so on and so forth. One can clearly see that there is a distinct level of correlation between per capita incomes and household debt. And another way of, let's say, measuring this kind of correlation is by looking at the household debt from in advanced countries and emerging countries. You will generally find that household debt in advanced countries, which typically have higher per capita income, will be much more than that comparable to an emerging market country. So as we can clearly see, India has a per capita income which is, let's say, half that of Brazil or China, and of South Africa as well. Over here, when it comes to per capita, we have used the purchasing power parity basis per capita income. Now, why did we use purchasing power parity? Because a rupee in India will actually probably buy you a lot more than what a dollar in the US would buy you. The relative cost of goods and services within different countries change. So when you do a foreign exchange to foreign exchange comparison, you might get erroneous conclusions. So for example, let's say if you wanted to compare all countries and compare all of them in US dollars, it is not a very good reflection of the actual potential of the country, simply because the relative value of those currencies in a particular country would change. So over here, we have accounted for those differences and then looked at the purchasing power, the per capita incomes. Clearly, India has half the potential, half the per capita income of China, and at $7,000 per annum, more or less, we have kind of reached the middle income status. The World Bank usually classifies a middle income as somewhere around the 7,000, 7,500 odd levels, and it is post these levels that you would start witnessing a rapid change or a rapid growth in per capita income levels. Other thing to note is India still has a per capita income which is twice that of the emerging markets. Now let's look at it from a household debt to a nominal GDP perspective. As you can clearly see, India at 22% household debt to nominal GDP compares quite favorably to every other comparable benchmark. Whether it is Brazil or South Africa at 25 or 33%, or China at 49%, we are significantly below these countries. So that in itself is a reflection of the growth potential which is there in the market. Now let's look at the comparison between India and China on a per capita income basis. So in this graph, what you have tried to plot is Chinese per capita income from 1997 to 2007 and India's per capita income on a purchasing power parity basis from 2007 to 2017. As you can clearly see, both India and China, India kind of lags China by a decade or so, and India's per capita income of close to 7,000 purchasing power parity basis USD is equivalent to what China had in the year 1997. So India is kind of, let's say, mirroring China with a lag of a decade. Now that we have established the link between per capita income and household debt, and then the link between India's per capita income and Chinese per capita income. Now let's look at Chinese household debt evolution to get an idea of what might happen ahead. So as we can clearly see, once China reached the 7,000 odd levels of per capita income, post that there was a big explosion in household debt increase in China. Overall debt increased from somewhere around the level of 20%. Bear in mind that the Indian ratio today is at around 22%. From 20%, it increased to around 49% over a space of a decade. We have also tried to look at how this debt was spread out between the usage of different products. So we have looked at, let's say, mortgage debt and non-mortgage debt. More or less, the debt was evenly split between mortgage and non-mortgage debt, except in the last couple of years, and that is to a large extent attributable to the rapid increase in home prices in China and the consequent higher leverage required to finance the purchase of these homes. But as you can clearly see, there has been a big rise. Now, we can use this experience to look at how the Indian market would evolve. So what we have tried to do here is construct, let's say, 3 different scenarios. In a 50% scenario means India actually manages to achieve a growth which is half that of China. 75% of the Chinese growth, 100% means we mirror the Chinese experience completely. So household debt to GDP would increase from 22% in 2017 to somewhere around 28% by 2022 if we have half the growth of China. And if we are able to achieve the full growth that China achieved, then our household debt to GDP would increase to around 34%. Now, we need to think about a couple of things to put these things into perspective. One, as we saw earlier, the emerging market household debt to GDP today, as of end 2017, was 34%. So even when we achieve 100% growth of China, we would still reach what the emerging market level is today. So in a way, that kind of reflects the overall potential that is there in the market. Now let's try to take this household debt and construct a rupee estimate for the overall household debt. So as of 2017, we have a total household debt as measured by all the accounts outstanding on the TransUnion Civil Consumer Bureau as 37 trillion rupees or 37 lakh crores. Now, of course, when we want to compute the average growth in rupee terms, we'll have to look at two different things. One, we have to measure what is the multiple or what is the household debt to GDP, which changes from a year to year. Secondly, you have to identify the growth of the nominal GDP also. For this exercise, we have assumed a growth in nominal GDP of 11.2%, which was the CAGR from 2012 to 2017. Considering our standard economic growth of around 7% and somewhere around, let's say, inflation of 4.5%, and 11.2% growth rate seems pretty reasonable. So now let's look at how the entire household debt and the entire, let's say, potential of the retail lending industry, how does that work out? So from 37 trillion rupees in 2017, under the 50% scenario, we will increase to 78 trillion rupees. That implies a CAGR of around 16.3%. Under the 100% growth scenario, i.e., we actually mirror the entire Chinese experience, the overall household debt would increase from around 37 trillion rupees to 94 trillion rupees, a CAGR of 20.5%. Now I'll give you a couple of facts just to get these numbers into perspective. One is a growth of 20.5% is more or less comparable to what the industry has achieved in the last 5 odd years. So in a way, the 100% scenario actually assumes that the industry keeps growing at the rate at which it has grown in the last 5 odd years, even though at a higher base now. That's one fact. The other fact is, as of now, let's say if we combine our Consumer Bureau, which actually aggregates all the retail debt held by retail and, let's say, agriculture debt held by the Indian households, as well as our Commercial Bureau, which actually calculates all the commercial debt held by all commercial establishment in the country, we come to a number of somewhere close to 100 trillion rupees. Now, at 94 trillion rupees in 2022, the retail lending market would be equal to the entire banking plus NBFC balance sheet, which is today. So that in a way underscores the growth potential of the industry. So now to sum up, our cross-country comparisons with our other EM peers indicates that there's significant growth potential over the next 5 odd years. Our closest comparable, China, definitely indicates that we're likely to have a significant income catch-up, and we are likely to have a significant household debt build-up also, which translates into significant retail lending revenue potential. And over the next 5 odd years, if the industry is able to leverage this potential, we'll probably see a CAGR in the industry of anywhere between 16 to 20%. One thing that you have to keep in mind is this is still a potential study. The actual growth in the market could be higher or lower depending on how the industry participants are able to leverage this growth. So now that we looked at the rupee size, let's try to look at this entire potential from a slightly different angle, which is the addressable consumer population angle. And this, in a way, is actually even more tougher simply because India as a country, in terms of macroeconomic statistics, we have pretty little statistics which come out with respect to the employment or income potential or of the households in the country. So, because of the lack of data, we have to look at a whole lot of different proxy statistics to arrive at the estimates. So, our entire methodology can be divided into 4 different steps. You first start off with, let's say, the total population. Then you do an age analysis. Ideally, we want to look at people between the ages of 20 to 69 because this is the age range under which a borrower would typically classify or qualify for a loan from a bank. Then we'll look for employment. More or less, you would need some kind of an employment prospect for any lender to give you a loan. So we'll have to adjust the entire population for labor force participation. Then fourth, we'll have to look for annual income of 250,000. Now, the reason why we took annual income of 250,000, we'll come to that later. Once you've done all of these adjustments, we'll come to the addressable market size. So let's start off. As you can clearly see, India had a population of around 1.26 billion in 2012. It increased to around 1.345 billion by 2017, and it is expected to reach somewhere around, let's say, 1.4 billion by 2022. Now, as of 2017, out of the 1.34 billion people, we had around 796 million people, or 59% of the population, which was within the age range of 20 to 69. The key point to note is there are around 500 million people who are below the age of 20. So in terms of demographic, India is one of the youngest countries. In terms of, let's say, a large country and a young country. These kind of demographics are not really that prevalent in most of the advanced countries. Going forward in 2022, we would expect the population between the age range of 20 to 69 to move from somewhere around 800 to 865 million. So on an average, we are talking about a growth of around 14 million people annually within the specific age range. So now what we have seen is we started off with a population of 1.345 billion. We are coming to somewhere around 800 million with an income age within the 20 to 69 age range. Now let's look at the labor force participation. Now, labor force participation in India is a pretty thorny issue, and I would say it's a little ambiguous issue, simply because even our government lacks access to regular granular statistics on employment. We do conduct a lot of periodic surveys on employment, but a countrywide survey which is able to track employment across both the organized and the unorganized sector is still something which is a work in progress. So the data that we have with respect to employment is pretty much limited. We looked at, let's say, different surveys that the Indian government carries out, and then we also looked at the International Labour Organization Labor Force Estimates and Projections. Now, this is an annual survey which is released by the International Labour Organization for all across the world. So they use standardized methods to predict, let's say, estimate the labor force participation rate all across the world. Now, what does labor force participation mean? As per ILO definition, a labor force participation means a person who's actually employed or who's looking for work, and the participation rate is defined as the number of people who are employed or looking for work divided by the working age population. So in a way, that's a percentage ratio. A couple of things will clearly stand out in the labor force participation rate. One is the significant difference between the male and female participation rates. Across all age ranges, you can see that the female participation rate is half or less than half of the male participation rate. In fact, various studies in India have pointed out that the labor force participation by females in India is actually declining over the past few years now. And there are multiple, let's say, societal and economic reasons which are leading to that kind of a phenomenon. The other point that will stand out is the low rate of labor force participation in the 20s age group. So people between the ages of 20 to 29 compared to any other age group. So if you look at, let's say, males, the participation at 82% is significantly less than the 98% or 94% that we see for males in the age of 30s, 40s, and 50s. Similarly, for females, you can clearly see that the participation rate of 25% is lower than the 35 to 38% that we see for females between the age ranges of 30 to 50s. So on an aggregate level also, a participation rate of 55% for 20s age group is much lower than the 68 to 70% that we see on the 30s to 40s age group. So clearly, we have a couple of challenges when it comes to the demographic dividends. I mean, demographic dividend is something that we keep talking about, but the fact that our inability to provide employment to the 20s to 29 age group is probably the biggest risk that we have when it comes to our own economic growth rate. And that will have a big role to play from a retail financing addressable population point of view as well. So now that we have these participation rates, we can calculate what's the labor force. How do we calculate the labor force? We look at the people who are, let's say, within a specific age band. So for example, the people in number of people in the 20 to 29 age group multiplied by the labor force participation in that age group will give you the actual labor force for that age group. So as you can clearly see, the labor force in India increases from somewhere around, let's say, 438 million in 2012 to 481 million people in 2017, and somewhere around 480 million, 490 million in around 2022. Now, one can clearly see that, there are different age bands, more or less they are expected to increase at roughly the same rate, and this entire labor force increases by around, let's say, 8 to 9 million per annum. Compared to, so we had a population which was increasing at a rate of around 14 million per annum, but now that we have used the labor force participation rate, we are actually looking at a growth rate of somewhere around 8 to 9 million only. And that to some extent is a reflection of a couple of things. One, bulk of the population was actually, let's say, the different age groups, and then what's the participation look like? So we started off with, let's say, a total population of 1.345 billion. We came down to somewhere around 796 million once we did the age cutoff, and now we come down to 481 million when we adjust for labor force participation. Now, there's only one last step, which is the income cutoff filter that we need to apply. Now, estimating incomes in India is extremely difficult, simply because even the government and a whole lot of other agencies, all of them lack statistics with respect to what's the actual income, which is employment income of households in this country. Then the significant low incidence of tax payments and significant underreporting for taxpayers kind of exacerbates this issue. So to pierce this fog of uncertainty, we have utilized the following 4 methodologies. And over the course of the next 15-20 minutes, I'll outline what are the 4 different methodologies. But in a nutshell, these are, we have looked at the income analysis of taxpayers in the country. We have looked at the Global Consumption Income Project Income Inequality Decile Analysis. We have looked at estimates provided by Oxford Economics, which is a pretty well-known economic consulting and forecasting house. And we have also looked at the income inequality study done by the World Inequality Lab. A couple of things before we start the analysis. One, considering the fact that we don't have any standard income criteria, we are looking at adjusted per capita GDP as an income proxy. So when we say adjusted per capita GDP, what do we mean? What we mean is we have taken the entire GDP, let's say divided the GDP now into the labor force, or we have assumed that only the people who are part of the labor force are actually contributing to the GDP, and that is the income that these people have. Then we have also identified a cutoff of INR 250,000 rupees or 2.5 lakh rupees per annum. Now, why did we arrive at that cutoff? It is our estimation that income of this level is enough to service a debt burden of an average consumer durable loan of around 15,000 or less. Now keep in mind that the retail financing industry today also provide loans to people who probably have incomes much less than this. So in a way, this is a conservative assumption that we have made. But we thought that it's better to be conservative and to err on the side of caution when it comes to potential market estimations. So let's look at first method, the income taxpayers. We have data till FY16 only, and as you can clearly see, roughly 80% of people reported an income above 250,000 rupees in FY16. So clearly 80% people having an income above the cutoff. To a large extent, this looks to somewhere around 6 million taxpayers in the past couple of years. But 6 million taxpayers on a base of somewhere around 1.34 billion still is significantly small. So that's the reason why to a large extent, this sample is biased. Secondly, usually income tax would be filed by people who already have an income which is significantly high. So by its very nature, the sample would be upwardly biased. Now let's look at the other method. So in this, what we have tried to do is to use the income inequality data sets to calculate as to how the GDP would get divided between various deciles. So the way to look at this graph is first the labor force bars. Over here, the entire 480 million workforce has been divided into, let's say, 10 deciles of 48 million each. So if you look at it, the first five numbers are 48, 48, 48. This is the first, second, third, fourth, and fifth decile. Then the 6th to 10th decile, we have aggregated them and made them into, let's say, 241 million. Now, in parallel to that, you can see the GDP in trillions. So the way to look at that is the first 48 million people in the workforce, they have a total income of 60 trillion rupees. The second 48 million people in the labor force have a total income of 25 trillion rupees. The third 48 million have a total income of 18 trillion rupees, and so on and so forth. Now the bars given next to the GDP trillion, that gives you the per capita GDP. So that would be, let's say, 60 trillion rupees divided by 48 million people. So that gives you an average of 1.25 million rupees, or let's say, somewhere around, let's say, 12.5 lakhs. The second decile would have an average income of 526,000 rupees, or somewhere around, let's say, 5 lakh rupees. 5,20,000 rupees, so on and so forth. As you can see, once you come down to the fifth decile, our average income becomes around 250,000. Now, we could easily say that 50% people are, let's say, above the 250,000 rupees. But if you look at it, income is something which slopes. So for example, the distribution of income is never uniform. You will generally find smaller number of people holding much higher, and that's pretty much clear from this graph as well, that as you move from decile to decile, there is a significant downward slope to the overall per capita income. So ideally what we would want to know is, within the fifth decile, at which point do we reach 250,000 rupees. So we used interpolation within the deciles to arrive at those numbers. Our studies indicate that at 43% of the labor force, you reach an income cutoff of 250,000 rupees. So we started off with the first estimate of 80%. Now we have a second estimate of 43%. Quite a big difference. So now let's look at the third estimate. And this is something which this is the data that we've used from Oxford Economics. So Oxford Economics gives numbers of household income depending on various, let's say, income ranges. Now we have converted those household income into a per capita income or an individual income by using a constant employment multiplier of 1.3 per household. Like we saw in the labor force participation rate, on an average you would find 1.3 of employed people per household. So that's the standard rate that we used across the time period to convert their household numbers into individual numbers. Once again, we can clearly see that roughly around 48% of the people have an income above 250,000 rupees. So now so we had, let's say, the first number is 80, second is 43, and third is 48. So now we are, to some extent reaching some kind of a convergence. Let's see what the fourth method brings us. This is another, so over here we have used estimates given out by the World Inequality Lab. This is a lab which was founded by Thomas Piketty. He is a very well-known economist, and his paper about income inequality in India actually was quite famous. And over here he has also looked at different levels of income inequality estimates. So in this we can clearly see that the ratios are quite different from the ratios that we observed in our method number 2. And to a large extent, this is simply because of there's a much more steeper income drop off. So using interpolation, we can find that the overall proportion comes out to be somewhere around, let's say, 30%. Personally, we think that there are a couple of methodological issues with this study. One is it assumes that there is a huge level of underreporting at the top end, but no underreporting at a lower end when it comes to the tax payment purposes. Now, we know that in India, a level of underreporting is actually prevalent all across the income spectrum. Secondly, the fact that we have just about 6 million taxpayers on a base of 1.3 billion, that in itself reflects that the sample is not very representative. So now let's look at, okay, what the four methods actually tell us. We had first method, the income taxpayer, which gives us 80%. Then we have method 2 and method 3, which are at 43 and 48%. And then we have method 4 at 30%. Clearly, the truth is somewhere in the middle. So what we did was we have taken the average of 43 and 48 of method 2 and 3 and used a base assumption of 45.7%. That's the number that we are looking at. So if you use the 45%, so to start off again, we started off with the total population of 1.345 billion in 2017. That drops to 796 million for the age range between 20 to 69. Then we adjust for labor force participation and we get a total population of around 481 million. And once you apply the income multiplier of around 45.7%, you get to the addressable market size of 220 million people. That's the kind of addressable market that we are looking at. This addressable market is 16% of the total population and roughly around 28% of the working age population. So now let's look at how has this addressable market changed over the last 5 6 years, and what are the key drivers. As you can clearly see, there is a significant correlation between the addressable market and the nominal GDP growth rate. 11 to 12% nominal GDP growth rate over the last 5 6 years has translated into a significant increase. The addressable population from somewhere around 130 million in December 2011 has increased to around 220 million in December 2017. Looking forward, we expect the addressable market to keep increasing by around 13 to 15 million people annually between 2017 to 2022. So what does that translate into? The overall addressable market would increase from somewhere around 220 million people in 2017 to around 300 million people by 2022. So to sum up, we have an addressable market of somewhere around 220 million people. We expect this addressable market to increase by around 15 million or so annually. And how does this increase come from? We're talking about 7 to 8 million people increasing simply because of the workforce addition. And we're talking about 7 to 8 million people increasing because of the rise in income. So let's say you had an income which was below 250,000, you move above that level. And so there's always the income catch up which is happening, which will lead to an expansion in the addressable market. So there is definitely tremendous opportunity for lenders to continue growing in the credit marketplace for quite some time. Now let's look at what is the, so now that we know, okay, what's the potential, we can now look at, okay, how much of the market has been penetrated by the industry so far. So first we'll look at active penetration. By active penetration, so let me define what active penetration is. Active penetration means so over here we are counting the number of people who have ever taken a loan. They may or may not have a loan right now, but if they took a loan even 10 years back or 15 years back, we are counting them as somebody who has taken a loan at least once. If you look at it, the gray line gives you that number. So on an average, the bureau penetration has increased from somewhere around, let's say 61 62% to somewhere around 72%. So what we could say that out of the 220 million people, the number of people who have taken a retail financing trade line, so by retail financing trade line I mean the following products. One is auto loan, used car, home loans, loans against property, personal loans, consumer durable loan, education loan, credit card, and two-wheeler loans. If you've taken any of these loans and you have taken it at any point of time over the last 15, 20 odd years, then 72% of those 220 million people are actually present on the bureau. There is some record of those people on the bureau. So in a way, the retail financing market has reached a 72% penetration from a ever basis. Now let's look at it from a live penetration, and that to a large extent will give us an idea about, okay, what's the current potential look like. When we say live, what we mean is let's count the number of people who have a live loan outstanding at that point of time. So over here, let's say if you had taken a home loan and you have paid it off, you will not be counted here. The only way in which you will be counted here is if you have a loan outstanding and you're paying an EMI at this point of time. So one can clearly see that the blue line, which gives us the retail lending penetration, we're talking about close to just about 33% penetration as of December 17. Now let's say if we remove gold loans from it, we reach a penetration of close to 27 or 28%. Now, if we further subdivide the retail financing market into asset lending and consumption lending, so I'll give you a definition of what asset lending, consumption lending is. By consumption lending, we mean, let's say, three products. These are credit cards, personal loans, and consumer durable loans. Typically products which are being used to finance consumption. And then we have asset lending products. So these would be your auto loan or a used car or a two-wheeler loan or a home loan or a loan against property. So if you look at both of these, asset lending and consumption lending, we are talking about close to 15 to 17% penetration as of December 17. So in a way, whether you look at, let's say, retail lending as a whole, or whether you look at asset lending or consumption lending, there is definitely a huge scope for growth. Now let's try to understand the penetration from a different product perspective as well. So over here, once again, we will look at, let's say, active as well as live penetration. So from an active basis, one can clearly see that two-wheelers is somewhere closer to the 20% mark. I mean, but that's the only product which has reached somewhere close to 20%. On an active basis also, for any standalone product, penetration is still below 20% on any major retail lending products. And over here, of course, we are considering anybody who has ever taken a people have a loan outstanding. We'll come to that. The other key point to note is the consumer durable loan, and that this is one segment which has increased significantly in the past 3 years or so. So the overall active penetration has increased from somewhere around, let's say, 6% in March 15 to somewhere around let's say around 11 to 12% by December 17. This is one product which has led to the rise in the retail financing industry, and this is growing at a furious pace. All other products are also growing reasonably well, but in terms of growth, consumer durables definitely outperforms every other product. To get to the market potential, now let's look at what's the live penetration rate look like. One thing which clearly stands out is when we're looking at active penetration, we're looking at, let's say, the 20% being the ceiling and none of the product managing to breach that. When we look at live penetration, we are looking at a much lower numbers. And in fact, for most products, the live penetration is somewhere around, let's say, 4 to 6%, with the exception of credit cards, which is somewhere around, let's say, the 9%. But even at 9%, we are talking about 9 out of 10 people still not having access to the loan at this current point of time. And that, in a way, underscores the tremendous growth potential of the industry. As of now, the retail lending industry is still characterized by consumers who are who are mostly, let's say, single product customers. In a way, let's look at what are the, so this actually, kind of reflects the newer customers into the industry. So to summarize, if India mirrors the growth performance of China from 2007 onwards, Indian retail lending market size in rupee terms is expected to increase from, let's say, by anywhere between, let's say, 16 to 20%. That would lead to the overall household debt increasing from somewhere around, let's say, 37 trillion rupees to more or less anywhere between 75 to 100 trillion rupees over the next 5 odd years. From an addressable market standpoint, we are looking at somewhere around 220 million people as of now. We expect this market to grow. We expect these numbers to grow by around 15 million annually over the next 5 odd years. This growth of 15 million is expected to come from two different sources: a growth of 7 to 8 million people through the addition to the labor force, and a growth of 7 to 8 million people by expansion of income. When we look at the current penetration, as of now, the market has a live penetration of just about 33% on an overall retail lending market basis. The penetration, when we look at on a per product standalone basis, we are looking at anywhere between, let's say, 4 to 9%. This, in a way, is probably the biggest factor which underlines the growth potential of the industry. That's it from my side. Now, any questions? Sure. So the question is, can we provide some idea about the distribution of people according to various income ranges above the income cutoff of INR 250,000 per annum? So as we clearly saw when we were doing the income analysis, the entire way in which the population ranges change is actually quite different. So yeah, when we are looking at, let's say, different, you know, so out of the 220 million people, chances are you would find probably 100 to 110 million people who have an income between, let's say, 250 to 500,000. And the balance 100,000, so balance 100 million people would have an income above 5 million. Let's say if you do the cutoff from 5 to 10, so let's say from, if you go from 5 to 10, you're talking about another, somewhere around, let's say, 60 million people coming into that range, and then around 40 million who are above the 10 million mark. So that's how the whole ratio will play out. And that to a large extent will also reflect what are the different products that the industry can target.
All right. So I hope Priyanka got the answer to her question. We have some more questions. Pranav from Delhi has written, what is the impact of labor participation by females on the overall addressable market estimation?
Sure. So, this is an issue which I think is quite germane to the country. And as we saw, the labor force participation by females is actually quite low. On an average, we are talking about close to 33 to 35% labor force participation in comparison to the 95 to 98% participation for males. And that has an impact on the overall addressable market estimation. When we look at, let's say, the Consumer Bureau data, we find actually similar number of borrowers also. So what you would find is the 1:3 kind of a ratio. And that's so for every female you would have probably, let's say, 3 males, both in the labor force as well as, let's say, in terms of the overall retail lending consumer base as well. And that to a large extent is simply the function of labor force issues. Now, I think that we need to come up with, so the industry, the society, and the government, all three of them need to come up with ways in which we can actually meaningfully increase the labor force participation by females. That in itself will lead to a significant acceleration in Indian GDP and would have significant multiplier impacts for female participation as well. Another issue that we think which needs to be considered is also that probably, product design and features have to take into account the fact or that females may actually have a different purchasing framework compared to males. So in a way, if product design by the industry allows for higher female participation, that would be much better.
We hope to see that soon. Next question is from Joseph. He has asked, what are the steps that the retail financing industry needs to take to expand the addressable market, particularly in India?
So there are a couple of things that we know. So from our research, we have seen that urbanization plays a very significant role in the consumer lending market penetration. When we, let's say, so over here, when we did the analysis, we have given you pan-India numbers, let's say. But if you do a penetration for a city like Bombay, or a city like Mumbai, or a city like New Delhi, you'll find that the penetration rate is much higher than the penetration in a rural area. So clearly there is a significant urban bias in the retail lending industry. And that to some extent is simply a function of the distribution. The industry initially starts off in the urban areas and then progressively it moves on. So we have looked at it from different product perspectives, and what we found is, things like, let's say, a two-wheeler that has much more wider distribution as compared to, let's say, a credit card, and that to a large extent is also a function of the technology infrastructure. So in a way, one thing that the industry can do is probably, think about how do you widen the geographical base. The second is product design to expand the market. So in a way, the addressable market in India expanded a lot in the last 3 to 4 years simply because of the introduction of consumer durable loans. If you think about it, these are loans which are given out at fairly low ticket sizes, and that has led to an explosion in the overall market size. So these are the innovations that the industry has to think about, both in terms of, let's say, product design as well as in terms of geography or channel diversification, and probably thinking of utilizing the online medium. So there are multiple steps that they can take to expand the addressable market in India.
All right, we'll take one more question before we close the session. Last question is from Sarah. She has asked, what are the key risks that might inhibit the future growth of the addressable market in India?
So probably the two big risks that come into my mind from a structural perspective are related to the opportunity. I mean, an opportunity or a crisis, they are just two sides of a same coin. So if you think about it, when we looked at, let's say, the labor force participation, couple of things that stood out was, one, the low level of participation in the 20s age group and the low level of participation all across the age group for females. Now that to me is is in a way a risk to the overall growth dynamic. If you are not able to create meaningful employment for people within the 20s age group, then we have a risk. The other risks are, let's say, much more macroeconomic in nature. So as of now, the Indian economy is doing quite well. Employment has picked up, but the fact is we are also battling with a few external shocks. So we are talking about a rise in oil prices, which has started impacting inflation as well as our external accounts. So those are things that the biggest risk is, if our economic growth rate continues at the rate of, let's say, 8 to 10%, our addressable market will keep growing. If our economy slows down, then your addressable market itself will get impacted.
All right. So that's about it. We won't be able to take more questions. Thanks a lot for an enlightening session and for your time. Thank you very much.
Thanks a lot for inviting me. Thank you.